Hello, my name is John Hearn. I'm a professor in economics and I also teach undergraduate courses in money, banking and financial services. On my YouTube channel there is an Economics 101, 10 lectures covering an introduction to economics. And this is going to be a series of lectures which is a sort of money and banking 101, introducing you to the degree courses which develop in financial services, risk, insurance, etc. The series will cover today's topic, which will be the roots of money and banking, and in subsequent lectures we're going to look at a lot of the terminology and how it should be used rather than often how it is used. We'll look at money and income multipliers and opposing theories about their impact on the economy. We'll look at efficiency in financial markets, central bank policies, whether or not we should separate retail and wholesale banking, a particular look at capital adequacy and liquidity, which is a source of great confusion within the context of prudential regulation. So I'll go through some fairly simple examples to separate those quite clearly in your mind. We'll look at the good and the bad of derivatives markets, and we'll look at trading, proprietary trading, casino banking and some of the new developments in money in terms of cryptocurrencies and Bitcoin and blockchain, etc. Some people find the sort of introduction to money and banking very difficult, and often the courses are made very difficult because you look at money and banking now and you try and disaggregate it and sort out the component parts, and it is a very complicated area. It's actually much easier to go right back to the start, if you like, in history and build up a pattern of how money developed and how banking developed, and then we can build the complex stuff on that. It becomes a lot easier to understand today if you understand quite clearly what happened in the past. And that's not difficult, it's nice and easy when life was simpler, and then when it becomes complicated you will be better prepared for this particular subject. So the lecture I usually give to undergraduates at the start of such a course was called The Roots of Money, Banking and Financial Services. So we will need to go right back to the start. But before I start, there's bankers, lots of quotes about bankers and money which have made me laugh over the years, so I often give those to my students as starters before we really get going. Mark Twain, he said, "A banker is a person who lends you an umbrella when the sun is shining, but wants it back the minute it begins to rain." Bob Hope actually comes from Eltham, near where I was born, but is thought to be an American comedian. He said, "A bank is a place that will lend you money if you can prove that you do not need it." Ambrose Bierce said, "An acquaintance is a person we know well enough to borrow from, but not well enough to lend to." Our great English author Charles Dickens, he said, "Credit is a system whereby a person who cannot pay gets another person who cannot pay to guarantee that he can pay." Now let us move forward. There's a definition of money which I would like to underpin almost all of the things that I say. It was set out by Francis Walker somewhere between 1848 and 1897, which was when they lived, and it says, "Money, that which passes freely from hand to hand, in full payment for goods, in final discharge of indebtedness, being accepted equally without reference to the character or credit of the person tendering it, and without the intention on the part of the person receiving it to consume, enjoy or otherwise use it than by passing it on sooner or later in exchange." Now that says it all. That's exactly what money is. It does pass from person to person in full payment for something and in final discharge of debt. It doesn't care who's giving the money. As long as the money is there, then it will be accepted. So there's no reference to the character or credit of the person. And the person who receives it doesn't consume, enjoy, or do anything with it other than pass it on sooner or later in exchange. So well done, Walker. That's the definition of money that we are going to refer to throughout the course. Now, does money do any good in the economy? There are lots of economists explaining the vital role that money plays and how important money is, and how whoever gets hold of money can do great and wonderful things. I don't agree with that. Money doesn't do any good at all, and it certainly does a lot of damage if there's too much of it or too little of it to sustain the average level of prices. In fact, the further you move away from stable average prices, the more the economy is damaged by these imbalances. So the important thing about money is there's just a sufficient amount of it available to maintain stable prices. And that's a necessary, but it's not a sufficient condition for an economy to function efficiently. Economies function efficiently for many other reasons which are nothing to do with money. So I would very much like to downplay the role of money in an economy. It's a very benign thing. It allows an economy to perform efficiently, but it doesn't do any good. It doesn't create jobs. It doesn't bolster the economy. It doesn't produce economic growth. It doesn't raise real incomes. It does none of those things. It's just that benign thing that is there and helps everything else work efficiently. So that's the sort of basis upon which I'm going to develop this introduction. Money should have 4 characteristics. It's got to be a medium of exchange. It's got to be a medium by which you can buy and sell. It's got to also account for things, be a unit of account that you can aggregate, subdivide to create relative differences between products. It's got to be a store of wealth. You don't really want money which is yours, you own, it's your wealth, not to be able to store that value. So it's got to be a store of wealth, and it's also got to be a standard of deferred payment. That means if I make an agreement today to pay for something, then you would expect that money to be able to do exactly the same job in a week's time or a month's time, perhaps not longer, because as we see, the value of money does change. But those are the sort of characteristics that you're looking for in money. Now, if you go right back in history, you look in the history books, the early forms of money, you will see reference to animal hides used as money, salt used as money, shells, particularly cowrie shells. They were very ornamental and had value for people. They were used as money. Dried cod in Newfoundland was used as money. Tobacco in Virginia was used as money. Sugar in the West Indies. All of these things have in the past been given as examples of the early forms of money. Now, just let us suppose, go right back when a hunter-gatherer society, and I'm a hunter, and in the cave next to me there's a vegetarian gatherer, and we generally subsist, we look after ourselves, but occasionally we swap things. It's a form of barter. We pass things in exchange to each other, and as a caveman, I'm a meat and 2 veg man, so I trade an animal skin, shall we say, for some vegetables, but my skin is actually worth a lot more than the vegetables that I require. So I'll add something else to it. I'll trade my animal skin for some vegetables and some salt. Now, I don't need this salt, but I know salt is generally acceptable and lots of people need it, and if I've got some of it, I will be able to use it to trade for something else. Salt has now taken on the characteristic of money because it's something I don't want, but I'm quite happy to accept in exchange for my animal's skin, because I know I can pass it on sooner or later in trade with someone else. So what are the characteristics of these early forms of money that made them good as money? Well, they had to be generally acceptable. They had to be durable, so they had to last, which could be a problem, of course, with salt, because if I pop it in the back of the cave and the cave starts leaking during a rainstorm and it dissolves all my salt, then I'm in a difficult situation, but hey-ho. It's got to be durable, got to be divisible. You've got to break it up into smaller components and add it together, aggregate it as well. It's useful if I can carry it somewhere. It's got to be portable, and there's got to be enough of it around for it to act as money, but you don't want too much of it to be around, or you don't want the quantity of it to change too rapidly, as it will destabilize trades that take place using this as a form of money. And over long periods of time, you would like it to be quite stable in its supply. Now, if we sort of come forward from the hunter-gatherer days, then the monarchy often got involved in money, because money soon became something widely used in the form of monetary metals, silver and gold. And of course, monarchs can't really earn any money. They don't do anything which people want to pay for. So setting up a mint was a jolly good idea. They could offer to mint people's silver and gold into coins, and a bit of marketing involved as well, because they can pop their face on the coin as well, which, as I say, is a good marketing ploy. Henry VIII was very good at this. He had a mint which he offered to change your metals into coins, and he realised, of course, that he could devalue these coins, debase the coinage. When he made the coins, he would include copper and other base metals in them. So much so that just over a 4-year period during his reign, he actually debased the coinage to 1/7 of its original value. So the gold and the silver was still there, but so much additional base metal was included that the metal was no longer as valuable. It was obviously a great idea, because he could take some metal, make 7 coins out of them, give 1 back to you and keep the other 6 for himself, and therefore finance his wars. And he did have 6 wives, didn't he? So there's lots of alimony to pay with wives, so much so, I think, that he started to chop their heads off in the end. He thought that was a cheaper way of getting through that problem. But he was one of the first kings who really did debase the coinage, and of course cause inflation. You'll see, if you see films made around this time, and indeed in later centuries, you'll see merchants in trade, chewing coins, just biting the coin, because they could tell through experience roughly how much precious metal was in the coin, and if there wasn't enough precious metal in the coin, then they would increase the number of coins that they require in order to sell you something, which is exactly what inflation is, or what causes inflation. So monarchs, people in power, have often got into a situation where they quite like the idea of creating coins, charging it for doing it, and also, if they're going to be a little bit naughty, debasing their value by adding base metals to these coins. Now let's come further up to date, because we're now describing a situation where people are using coins and they're passing them round to each other in trade, and those coins are then money. You don't want them for any other reason other than to be able to pass them on to other people in trade. Now, you had a period of time when quite a lot of emigre Jews came to London to live in East London because of persecutions in various parts of Europe, and their trade was that of being a goldsmith. And a goldsmith just then meant really a jeweller, so they would make jewellery out of gold, but they would have vaults to keep their raw materials in and keep them safe. And in 1640, good old King Charles I, he raided the royal mint and took away lots of its gold, which made people a little bit concerned about security. There was the English Civil War, which started in 1642 and went up to 1651. During this time, rich people, they weren't going out and buying jewellery during this period of time, but they did have quite a lot of things that were valuable, gold particularly, that they were worried might be stolen from them. Now the goldsmiths, they had vaults, and they had hopefully good security cameras and good security systems, and they offered to be depositories for these golds. So you could no longer make a career out of making jewellery, but you could earn some money by looking after other people's gold and rich people's things other than gold. So the goldsmiths became depositories. Now, if you deposited your gold with a goldsmith, you got a receipt. With these receipts, a person could actually go out and use it as money, because if they wanted to buy something, they could say, I've got this amount of gold at this goldsmith's, and we trust this goldsmith, don't we? And if I just sign the back of this receipt, I'll transfer the ownership of the gold to you. Now that's much more convenient, transferring pieces of paper receipts for gold to each other in trade, than it is to go to the goldsmiths, take the gold, mint it, pay off the debt, and then that person probably puts the gold back in to the same depository or another goldsmith's depository. It doesn't matter. So goldsmiths' receipts start to be passed around as the early forms of paper money, and a goldsmith with his or her head screwed on would go, you've deposited £1,000 worth of gold with me. Do you want one receipt for £1,000, or do you want one receipt for £500, 4 receipts for £100, 4 for £20, 1 10 and 10 ones, or whatever it is that adds up to 1,000. So by giving receipts in smaller and smaller denominations, they could be used to purchase things, rather than have just the one receipt for £1,000, which wouldn't work as well as having lots of different receipts where you could transfer the ownership of just bits of the gold that you own in order to purchase particular things. So these receipts are then used as money. They become the standard form of money, paper money, which were goldsmiths' receipts in lots of different denominations. Now that meant that money was, in this example, and this example is not perfect in terms of its historical accuracy, the important thing about this is it's just a straightforward sequence in logic, which will explain to you exactly how money developed. And in this first particular instance, money was just that one big circle. It was gold, and there were lots of little bits of paper, receipts, that were then used as money, which were all claims on that gold. In other words, the total amount of gold has receipts circulating which are 100% backed by gold. So there's been no money creation in this process. It's just receipts have now replaced the exact same amount of gold and are being used as money. Now, if you were a goldsmith in those days, you could think about returning to making jewellery, or you could think of doing other things, because what you found now is that you're looking after a lot of gold from people. People don't need that gold. What they just need is to pass around the receipts one to another, and that gold just sits in your vault. There are also people out there who want to borrow money and might well approach you and say, look, could you lend me some gold for a period of time? Governments often would be interested in this, although they did have their own Bank of England, which was set up in where were we? 1694, if I remember correctly. So people would want to borrow gold, and the Goldsmiths knows that the gold stays there most of the time. Sometimes people want to take a proportion of it away, but it's nothing at all. There's gold there. So we could lend out the gold to people. Now that is the beginning of banking. Not when you're a gold depository. That's a precondition, if you like, a precursor to banking. But banking really starts when goldsmiths start to lend out some of the gold. Now, when you lend out some of the gold, people may want the gold. They may want to take it away, and we'll repay you in a month's time or a year's time, or however long you negotiate this loan for. So people might want to take the gold, but more than likely they would be quite happy just to have your receipt. So you can give out another receipt for the value of that gold, albeit temporarily, until it's paid back to you. But as soon as you move into this process, what you now find is that there are actually more receipts in circulation for gold than there is gold backing. As soon as you create loans to customers, give them receipts, then you go through a period of time when there are more receipts in circulation than there is gold. You've got to keep enough gold always as a proportion of the receipts that or the notes that you issue to satisfy everyday demand for gold, because you know there are people who come in, look at it and take some of it away. So you've always got to make sure you've got enough gold there. But experience would tell you over time that I could say double the amount of my notes in circulation, and at most people would ask for perhaps 5% of my gold on any one day. So I've still got 50% backing for all of the notes in circulation. So this is quite a safe situation. Of course, it's a big money spinner, because I'm charging interest on all of these notes that I am issuing. And we've now got into a situation where we have got money creation. We're now in a situation where money looks like this. It's now two concentric circles. It's the original gold that was deposited, but the amount of money in the economy has expanded as a result of paper receipts which have been issued in excess of the gold in those vaults. So what the early bankers did was allow the money supply to expand in a way that was fairly controlled. They originally earned money by looking after people's gold. They might even now want to pay people to look after their gold, because the more gold they get, the more they can lend out, and the real money spinner is lending out money rather than just looking after people's gold. But these are private banks now, and you could always think, and there were examples of banks failing because they become a little too greedy. That is, they see all the money that can be made by issuing loans and issuing new notes. And if they issue too many new notes, and all of a sudden there's a run on their bank, more gold was asked to be taken out than usual, and they can't do it, and people lose confidence in them as a bank, then they're likely to have to close the back door and run away quickly because they are not in a situation where they have got sufficient gold in their vaults to pay those people in gold who demand to have their gold back or to use the gold that they've borrowed. So get too greedy, you could end up going out of business. But we now have the first bankers, and we have what you would describe as an unofficial gold standard. Because all of these receipts are backed by gold. They're not 100% backed by gold, but they promise to pay the bearer in gold, and as long as people don't want it all back in one go, they can always have bits of it whenever they like. So they're confident. We are now on a gold standard. Every note in circulation is backed by gold and promises to pay you the value of the receipt that you hold in gold, if you want that to be the case. So the gold standard produced a relatively stable situation as far as prices are concerned, but not totally stable. It was an unstable situation, in as much as you got periods of inflation, rise in the average level of prices, periods of deflation, fall in the average level of prices. So you had what you later described as trade cycles taking place, and they would often be linked to discoveries of gold. Because the thing about gold is that when you go out as a prospector and you find gold in them there hills, then it's very difficult to keep quiet about it. You often sort of run down shouting, gold, gold, I'm rich, and straight down to the pub, and you start buying everyone drinks, and eventually when you're drunk you tell them where you found it, and then everyone rushes. So there is a gold rush. Once it's known where gold is, everyone's out there. So a lot of gold comes out of the ground over a very short period of time. So there is now more gold in circulation than there is trade at the current level of prices. So what happens is prices go up, you get some inflation, and the price of gold is the only thing that goes down. So the value of gold goes down, and it becomes less interesting to prospect for gold now, because its value has fallen. But again, over time, every year, steady growth in productivity, in output of the economy, gold starts to become relatively short in supply as a medium of exchange, as a form of money, and its value starts to rise. And as its value starts to rise, people start to prospect for gold because it's now increased, and then they find it somewhere else. So there were gold rushes in America, in Australia, in South Africa, all associated with the price of gold, and all creating some inflations and deflations during the 18th and 19th century. So if we looked at a sort of time line for the 19th and 20th century, and we looked at inflation and deflation, we would find gold creating some instability in the 19th century, prices rising a little, falling a little, linked almost precisely with discoveries of gold rushes. And then we move to a period of time that we'll talk about a little bit later on, which is where governments actually sort of take control of trying to manage this cycle of ups and downs, and there you can see is the point at which the very opposite happens. Money becomes much more unstable. First World War, Great Depression, Second World War, and so on. Now this is not precise in any way, but it illustrates the point to you that gold was relatively stable compared with the century after, when governments really took over trying to create stability in terms of money. They didn't do a very good job of it compared with the job that gold did automatically, without any attempt to really create stability. So what you have is lots of banks which are circulating notes backed by gold. Now governments actually see here an opportunity, and the Bank of England, the government's bank, is involved in the same sort of process. And in 1884, the Prime Minister Robert Peel passed the Bank Charter Act, which actually gave the Bank of England a monopoly over printing notes. and it also allowed a fiduciary issue, an excess of notes to the amount of gold the Bank of England had, to the tune of £14 billion. Other banks were still making loans, so between them, the government, the Bank of England and the private banks were expanding the quantity of money in the economy. The quantity of money in the economy then had two components to it. It had gold at the core, and then money created by bank loans. So we're now, if you like, coming up to the 20th century on an official gold standard set up by government with the Bank Charter Act of 1844. All notes, bankers' receipts, Bank of England currency, cash, were convertible into gold. Now, unfortunately, 1914, you had a war, a world war, and you need to finance wars. And technically, there are three ways you could finance them. You can increase taxes, you can borrow money from people, or you could print money. You could just create new money. And so that's exactly what the government did, because it's nice and easy. You can just create more money, go out and buy all the things you need for your war effort. You cause inflation by doing it. So the 1914, 18 years were very inflationary years because of the money that was being created. And you indeed had too much money in forms of notes in circulation compared with the amount of gold that backed it, so much so you suspended the official gold standard during the war. You had inflation. Now, after the war, you've got three alternatives. You could return to gold at the pre-war rate. Now, that would involve destroying some of the notes in circulation to produce the right ratio between notes in circulation and gold in the bank. You could devalue gold, so you could return to gold at a devalued rate, or you could say, forget the gold standard, we're not going to return to any form of gold standard and just leave the notes in circulation. So return at the pre-war rate, which involves destroying currency. Try and devalue it and leave the currency and the gold more or less alone, or don't return to the gold standard. Now, the worst of all of those would be to return to gold at the pre-war rate, as they found out, because the governor of the Bank of England at the time, was it Montague Norman? I hope so. Not sure. The governor of the Bank of England, he actually said the disadvantages to the internal position are relatively small compared with the advantages to the external position of returning to gold at the pre-war rate. See, there were people holding sterling. Sterling was that sort of reserve currency around the world, and people were holding sterling. About 5% of sterling was held outside the UK, and these people would have had it devalued if we hadn't returned at the pre-war rate. And indeed, the Cunliffe Committee produced a report which supported exactly that. We need to return to the pre-war rate for gold. So the only way the government could do that was through its fiscal policy. It budgeted for surpluses, removed the cash from circulation, destroyed the cash. With tremendous damage to the domestic economy, you had a period of deflation after the First World War, which historians always look back and blame greedy capitalists and mine owners and factory owners for all of the things that went on during that period. But believe me, it was the Bank of England that caused the problems after the First World War by making a silly decision to try and return to the pre-war gold standard and go out and destroy all currency, because all prices have gone up. Now all prices have got to go down. And as we now know, getting prices to go down means you've got to get all incomes to go down as well. And it's very difficult to get incomes to go down in any nominal sense. Even if you tell people, no, prices are going down, you know, we can lower your wages and you'll still be as well off as you were before. People fight for their nominal numbers. It's called money illusion. And it created really a decade of damage in the UK economy, because cash was destroyed, prices fall, wages fall, and because of this sticky wages, they were called, whether it was difficult to get them down because people would complain about it and go on strike and generally be annoyed. Unemployment rose. We did, however, destroy enough currency to be able to return to the gold standard in 1925, but things still got worse. We had a general strike in 1926, and we really had a decade of deflation and damage, recession and depression. And it's quite interesting to set that within the context of the world at this time, because around the world things were different. In Germany, they had hyperinflation, money falling in value by hundreds of % an hour during the real height of this money-created hyperinflation. In America, it was the Roaring Twenties. You know, read your Scott's Fitzgerald. You'll see what life was like, because they didn't have hyperinflation, they didn't have deflation. Things have gone very well in the USA, so well, in fact, that they did have a bit of a blip in 1929 called the Wall Street crash, which was just really a minor problem. But the USA made the same mistake as the UK at that time, and actually set something in motion which destroyed lots of currency. It was an inexperienced Federal Reserve. They'd only been set up in 1913, and their first real crisis was the Wall Street crash. And there was a particular Bank of the United States, which needed support, and the Federal Reserve didn't support them. It didn't provide them with the liquidity that they need. I have no idea whether this is correct, but I've always felt that the Federal Reserve had to give itself a different name than the one it would have liked. Would have liked to have been the Bank of the United States, but someone already had that name, so it called itself the Federal Reserve. And then when it found itself having to support the Bank of the United States, it said, nah, we're not going to support you. It didn't. There was a series of bank failures across the whole of the USA, and the money supply contracted by around 30%. Deflation occurred, and all the characteristics of recession and depression that we'd seen in this country were repeated again in America. And because America is so large, it continued the difficult times that we had in the UK, and indeed throughout the Western world, throughout Europe. So you did have, through the 30s, very high unemployment, disillusioned people, weak economies. Extremist groups always develop when economies are very weak, when there's no economic growth. And believe it or not, you were setting up conditions, perfect conditions, for another world war, which very sadly happened. The gold standard was abolished in 1931, so our official gold standard had gone. But when World War II was over, then we had a conference at Bretton Woods where we decided to set up the best we could, not an official gold standard, but a gold exchange standard. So notes that people held were no longer IOUs for gold. So there were no IOUs, but there were IOUs to central banks. So central banks traded between each other in gold, but no individual could get back the gold that their note said, I promise to pay the bearer. That had gone. The whole system was supported by gold at Fort Knox, and exchange rates between currencies were fixed. So if you had deficits and surpluses on your external current accounts of your balance of payments, then they tended to be settled in transfers of gold between countries. Transfers of gold between countries allowed countries which received the gold to reflate their economy, to expand their economy, and those countries who lost gold were in a position where they had to deflate their economy, and that created a balance once again on the external account that allowed you to maintain your fixed exchange rate. This gold exchange standard continued until 1971, when pressure on governments, Vietnam War in in America and Keynesian economics in the UK caused the collapse in the gold exchange standard, and fully fiat currencies were born, which is a fiat currency is not backed by anything, despite what some economists say. They're not IOUs anymore. It's not an IOU if you can take a £5 note and get another £5 note in its place. It's only an IOU if you can get something different from a £5 note, like £5 worth of gold or whatever it was before. So we now have fiat currencies, and if we wanted to look at fiat currency, it would look very similar to what we had before. We've got cash in the middle instead of gold, and we've got loans created by banks, creating money such that we have two concentric circles now, one which we could call cash and the other one we could call credit, created by bank loans. So the total amount of fiat currency still has these two components in it. It's no longer gold and bank loans, it's now Bank of England, cash or currency, and bank loans that are built upon that. Now, what happens as that old money converts into new money or fiat money is that its characteristic changed. The old money, which was an IOU, had two values. It had a value in use and a value in exchange. As gold, you could use it to make jewellery, or you could use it as money. So it had a value in use and a value in exchange. Whereas fiat money has no value in use. You've taken that away, unless you want to paper the lounge in notes. It has no value in use. It only has a value in exchange. So old money, two values, use and exchange. New money, now only a value in exchange. You can use it to buy things, but you've lost the IOU or the value in use. You can't use it for anything else. Now, we've got to a period of time where we've got fiat money, a fiat currency. We've got banks that grew out of Goldsmiths. So we've got the normal banking functions continuing, where banks are accepting deposits in cash now, whereas they used to be in gold, and making loans to customers, and creating new deposits. They don't create new deposits all the time. Another mistake made by some economists. Banks are often just recycling the money that has already been created in the past, and it's only at the end of the day, if there is a net increase in the assets of the bank, that you can say that any new money was created, and that's very slow and very rare. So banks were basically intermediaries between the surplus sector in the economy, those people who had funds available to save, and those people who were in the deficit sector of the economy, those who wanted to borrow money. And they developed into the retail banks. And there was also an investment banking sector, or a wholesale banking sector, which was not banking in the traditional sense, in as much as it took in deposits. In fact, they were really just companies which offered a wide range of financial services, but they may be owned by a traditional bank, and indeed after the Big Bang, then many of the big retail banks bought out the wholesale banking sector and created a conglomerate of banking, if you like. So that financial services offered by banks has expanded into financial advice, underwriting, issues of shares, initial public offerings of shares. They offer personal, professional and business insurance. They sell a wide variety of investment products. They help companies through mergers and acquisitions. They also will trade and invest on behalf of their customers. And then one thing that does worry me a little bit, as you'll see as things unfold in these lectures, they get involved in proprietary trading, which is trading on their own book, and much of what goes on in that sector has been described by people as casino banking, which we are going to investigate in more detail in later lectures. We're in a situation where central banks have looked after money, but I don't think there's any indication that they have done a good job looking after money. This has created a situation where the door is open, if you like, for the development of other forms of money. So you've got a lot of hype around Bitcoin, the cryptocurrencies, blockchain. You've got CBs, central banks, fighting back with their own form of digital currency, which is being discussed, the central bank's digital currency. So there's a lot of things happening at the margin now on banking, central banking, and the traditional forms of money. Are they moving on now to one further stage of development? Are they moving into a new era of cryptocurrencies? Those are the sort of things that we are going to look at. Now, if you take what I've said and you sort of see the sequence of events as money developed and banking developed and banking grew and banking expanded, it should be fairly easy to see the process of what money is, how money developed, how banks were involved in creating new monies, and how central banks have tried to manage this particular process. As I say, not necessarily managed particularly well. I've written a lot about this in other areas, so that you can actually have a look on my blog, which you'll find at jbhearn.wordpress.com. You can actually join me on Twitter, where you'll see lots of people arguing with me about the things that I say, which might be a bit of fun for you. You can join in the argument. Quite a lot can be learnt from a little bit of banter on Twitter. And if you go to my blog, there are articles, there's one, Decades of Mistakes, that the Bank of England has made over the last century. There's what should banks be doing now, the problems of the rates of interest, their response to the global financial crisis of 2008, their response now to the pandemic, what might be called the global economic crisis, as it unfolds. So there's lots of little bits of reading around that hopefully will expand your thoughts on this process. So we can assume, having listened to this, that you now understand a little bit about money and how it developed, banking and how it developed, and how there were a lot of other financial services which spun off from banking. And in the next lecture, we'll start to unravel some of the more complex things that will bring us right up to the present day in the way that banking works. I hope you've enjoyed that. Thank you for listening.